Hello, everyone. This is Maria Horat with Gold Country Properties, and today we have Jodie Luke-Carter, and she's a senior loan consultant with New American Funding. Hi, Jodie.
Hi.
How are you?
Good, good. Thanks.
Thank you for joining me today. And
Oh, yeah.
basically, let's talk about rates. We've seen that the average mortgage rate on a 30-year mortgage jump. I think it was 27 basis point following the release of the job report, which is 42 basis points higher than the day the rates were cut, a half a percentage. So I know
Yeah.
it's supposed to follow the 10-year treasury, but what do you think the Fed might do next? Do you think they're going to keep?
So that's like such a good question and kind of the question everybody has on their mind. They're supposed to meet again in November, the beginning of November, on the 8th. And so if they if we anticipate that they're going to drop it, um, a half of a point, then the market will start hedging there. So one thing about rates is the market starts hedging there when we know that the rates are going to drop. So last time when they announced the half a percent drop, the market was already hedged there, meaning everybody knew that was coming. And rate all the lenders were dropping the rates, the banks were dropping the rates, knowing that that announcement was coming. So when it came on the day it did, business was as usual. You didn't see a huge drop because we'd already been hedging that way all week. But then what happened is the actual market, the economy wasn't as strong. And so it caused the rates to go back up. And rates are actually a little higher than before we got the rate cut or we were anticipating it. So, two things will start to happen right before we hit November 8th. One will be that if the market is looking steady, the stock market and the job market, then lenders will start lowering the rates in anticipation for that other rate cut.
Mhm.
If it looks like we're going to get it, you'll start seeing that, and that's really the time to be getting your refinance or your purchase in place is right before that rate cut. Because if we're anticipating it, you'll see rates going down, and then once it happens, it's already in place. And if we get a bigger rate cut than we expected from the feds, then rates will go down a little more. If it's the same, like it was last time, rates will stay the same as where they already hedged to. And if they announce less, like let's say they say only a quarter instead of a half, then you'll see rates come up right after.
Mm.
Um, so this last time, we just did do exactly what we thought, which was they gave us a half. We expected a half. Everything stayed steady for a few days, but then the market didn't go so great. So
Mhm.
now that's causing rates to come back up again for people.
So let's talk about housing affordability, which is the biggest issue of our time right now, as far as
Yeah.
renting. According to the latest data from the California Association of Realtors, only 14% of Californians are able to afford a median price home, and only 33% of Americans are able to purchase a median price home. So we know that the cost of living is up and consumer debt is higher than it's ever been.
Hmm.
According to the Bank of New York, the total credit card balance totals $1.14 trillion in the second quarter of this year. So that's the highest it's been since 1999, which is when
Hmm.
they're tracking these numbers. So what steps can people start taking to improve their credit score aside from taking a second or third job in order to pay down credit card debt and cutting any wasteful expenses to make a path to buy a home? Is there anything else they can do, like consolidate debt? Anything that you would recommend?
Yes. So for first time home buyers, I always recommend if you have debt and you're trying to get that paid off so that you can get into a home, that you want to try to, there's a lot of offers out there that are 0% um, intro rates. Try to get it transferred to that. It does, yes, affect your credit because you're opening a new credit card. But remember, if you do, it's the least effective, like it's not going to affect it as much. So you want to open a new credit card, get it transferred to the zero balance, and start making payments as fast as you can. But do not close the other credit card. If
Mm.
you are afraid of using it, cut it up, throw it away, but don't close it out. Because when you close old credit lines that have been established, it actually hurts your credit. So you don't want to close it out, but you want to just get rid of it out of your life. Don't think about it. Act like you don't have it and let it sit there for the next 20 years. But go ahead, get the zero interest one. If you don't have the option to get a zero interest card or you're not able to find one, than a debt consolidation loan. The one thing I see a lot of people do is debt relief. And that is, I am against that because debt relief, their programs, what they do is they tell you you need to get behind on your bills, then they're going to settle them. And I have seen so many people's credit for 5 to 7 years be tanked by those companies because they keep you in them. They keep telling you you need to be behind 3 months, now 6 months, now 4 months, and we're going to settle all these for you. And the problem is they do settle them eventually, but you're getting those late payments hitting your credit every single month. Um, and their promises to rebuild it don't happen because even when you settle, you're doing a less than owed. So that's hitting your credit too. So what you want to do is if you do really need help with debt consolidation, call the creditors yourself and try to arrange a settlement with them directly. You don't need a third company to do that for you, and you don't need to be behind to do that. They will settle with you.
That's great
Mhm.
advice.
Yeah.
So we have seen that despite the affordability issues, some prices are still holding up in some areas. The median sales price in California is 888,740, which is slightly up year to year by 3.4%. There's still a lack of inventory, as we have seen many homeowners can't afford to upgrade or buy another home at this much higher interest rate than what they probably had at 2 or 3%. What about the first-time home buyers? Let's talk about FHA. The minimum income required to buy a home in California is 158,400, according to the California Association of Realtors. Of course, this varies per county. So what will be some things to keep in mind for a first-time home buyer in order to get pre-approved for an FHA loan? And explain, of course, what the FHA loan is and some of the health and safety requirements that the property buyer wants to buy must meet.
Yes. So FHA is such a great program because it does let you do that 3.5% down, and it levels the mortgage insurance. So it gives the same mortgage insurance to everyone, which is great. It's kind of a set mortgage insurance, and it's reduced from like if you went conventional and put 5% down, and if you had to get mortgage insurance, you're actually going to have less mortgage insurance usually with FHA. So that's why people choose FHA. They also have slightly lower interest rates than conventional loans. So FHA is great for that. If you want to get an FHA loan, there's a couple options. In California, we have CalHAFA, and we have also at our company, we have our own 100% program that's FHA. That's a NAF program. That's New American Funding, and it's called Pathway. Both of those give you down payment assistance for first-time home buyers. So it's an FHA loan, and then we bring in either CalHAFA or our own in-office program, which I love to use because it's easier to get through underwriting. But those will allow you to finance your down payment. So technically, you're just now coming in with closing costs. For those, you do need a 620 credit score. So your score does need to be a bit higher than a regular FHA loan, which is 580. So if you have a 580 credit score, you can get an FHA loan with 3.5% down. If you have a 620 credit score with FHA, then you can get down payment assistance. And if you have a 660 credit score, you can get forgivable down payment assistance. So those are some of the things with FHA. Your debt to income ratio has to be 46 on the front end, under 46 on the front end, and under 56 on the back end with FHA. And what that means is your front end is your housing expenses, just your housing compared to your gross income. And then the back end is all of your debt plus your housing. So imagine your house payment needs to be no more than 40%, 46% of your income, and that's your gross income, not your net. And then your housing plus your debt needs to be no more than 56. And I can help you get those in line, or your lender can. Whenever you come to me and I filled an application, I can say, hey, if we pay off these two cards, you're in the ratio. Or hey, you're already in the ratio, whatever. But we can figure out how to get you into that ratio. So getting your debt to income ratio in line, making sure you have the minimum score of 580, or if you need down payment assistance, 620. And then making sure you're finding a property that's FHA financeable. I know you had that recently where a deal was having a hard time because there wasn't a requirement met. FHA does have health and safety standards that you have to meet for the property, and that is like exposed wiring, working smoke detectors, hot water heater straps, um, any dry rot or flaking paint. Um, that would mean like on the outside of the house, some houses are older and the paint's
Right.
flaking or deteriorating or the wood is rotting off. Those
Yeah,
types
well,
of
like
things.
1978, prior to 1978 or something like that, right?
Mm-hmm. Yep. And then the other thing is roof. So you have to make sure the roof has at least 2 years of life left. So if the appraiser felt that the roof didn't have 2 years of life left, he would call that out and then we would have to get a certification. But if it looks like it does, you don't need to worry about that. But that is one of the things. And then the other one is active leaks. If they find any active leaks, they'll want those to be repaired or termites. So any termite activity, they would need to be repaired. So those are things that you want to kind of keep in mind when you're doing an FHA property. And if you find a property that has a couple of those items that you think might need to be repaired, you just want to make sure you ask for those during the escrow and in the process, and that the seller is willing to work with you on getting those done.
Right. And
Hmm.
a lot of times, those agreements cannot be met during escrow, and the buyer has to think about, well, is it worth it for me to do it before escrow? There's always risks about, doing it that way.
Yeah, there is. I've had some buyers who are like, "Hey, the seller gave me a good deal and they're going to let my painter come in and touch up the lead-based paint." And the buyer's putting that out before closing.
Right.
Obviously, you have to have permission to do that, and everybody has to be on board, and you need to have a licensed person. So there's those types of things. Or I have some buyers who offer a little more. So maybe the house was, 400, and they're saying, "Hey, seller, if you do these repairs that I know that I need for my loan, I'll offer you 405." So the
Mhm.
seller's still getting what they want, and the buyer's able to use this particular loan type. So there's ways that your agent and lender can work together to try to make that work for the seller and for everybody.
Exactly.
Mhm.
And I know how we said it was a first-time home buyer loan, but what about a homeowner who has had the house for many years and now wants to buy another home? Can they get pre-approved for an FHA loan, or do they have to not be homeowners at all?
They can. FHA is not only for first-time home buyers, but you do have to be purchasing a home more than 100 miles away from your current home.
Okay.
So if you're trying to go within the same county limits or close to home for your second home, then you would want to go conventional.
Mhm.
Um, and if you're needing the down payment, sometimes we can do an equity transfer or a bridge loan, or we can take money out of your first house that you have the equity in and we can put it down on the next house. So that's something I see a lot that happens. They rent out, and then we have the agreement that they're going to rent out the old one. We take the equity out of that one and put it down on the new thing. So that's something that can be done. And we do quite a bit. Let me see. I'm trying to think. That's probably the most common way to do that.
Yeah.
Um, or sometimes people will cash out refi um, their home, the other home, if they don't want to do a bridge or a second, they can do a cash out refi and then take some money out of it, pay off debt, and buy the other house. So
Right.
that's also an option. If you have debt and you actually have a house, you can get a cash out refi because although, yes, the interest rate might be 6 or 6.5 on a cash out refi, could be better than your 20% or 29% credit cards right now. I mean,
Right.
some credit cards are like a 30%, and it's amortized over 30 years, where credit cards are not amortized over 30 years.
Right.
So it could actually bring your monthly cost down too.
And
Mhm.
the bridge loan that you were talking about, what's the average interest rate for that?
Um, so those are very, very buyer specific.
Okay.
I have seen them because maybe somebody needs 40,000 or 50,000, and because they are lower loan amounts, the rates are going to be higher, right? Because the investor has to make money, and the payments are still very low. So usually you're going to see. I've had a couple at 7.99, and I've had them go up to 10%, just depending on the debt to income ratio of the borrower, the equity in the home, like how much equity they have, if they're using almost all of it, or they're really still have a lot left, and then the credit score. So those types of loans are very buyer specific. I always tell people I really have to run that through because a lot of it's based on your equity position.
Right.
Hmm.
And as far as investment properties, we know that it has become increasingly difficult to find income producing property now with the interest rates the way they are, right? So
Yes.
unless somebody makes a huge down payment. So what kind of programs are out there available, loan programs that an investor might need or might look at if it makes sense?
Yeah. Um, One thing to think about with rentals, and I'm sure you've thought of this too, is I always tell people if it is hard to get them to cover without 20%. And it doesn't really matter what loan program you're doing, it's going to be difficult and probably not possible. So you do have to decide to, am I looking at this as a long-term investment? Usually the clients that I see buying rental properties are saying, yes, I am putting this money into it. I may have to supplement 100 or 200 a month, but this is going to return more money than any other investment I can do, stock market, whatever. I mean, I'm putting 100 or $200 into the stock market and it's not giving me
Right.
30,000 after 5 years, you know, like a house can, or 40,000. So you do have to kind of look at the big picture right now when buying real estate, I feel like, because there is no really specific loan program for an investor, that's going to make perfect sense, unless you're getting a great deal on the house.
Right.
Otherwise, the loans typically with taxes and insurance, you're going to be breaking even or possibly putting 100 or $200 in there.
Yeah.
So,
What
mhm.
about vacation rentals? I know in the past, and I don't know if there's been any changes, you gotta basically prove that you're gonna get an income for long-term rental. Is there anything for vacation rentals that might have changed, or is still basically the same requirement or stricter?
So it's about the same. They haven't really come out with much new requirement or anything new on that, because if you have a vacation rental, and you're buying a vacation rental, you can use the vacation rental's history as long as it's been over a year. If it has 2 years, you're going to get an even better option. So
Right.
if you're buying an active vacation rental that's already had the history of it and we can prove that, then that will help you get the loan on that.
Okay.
Um, and that can help. But if it doesn't have a history of short-term rental, then we have to prove long-term rental income, which how we do that, even if you decide to short-term renter it, we still have to get the long-term rental information. And we
Right.
do that by ordering a rent survey on the appraisal. The appraiser will tell us what the rents are, and then that's how much credit we can give you against your income.
Okay.
Um, and then, of course, if you start renting it short term after you have it, you just want to keep good records of that so that when you go to refinance it or sell it,
Mhm.
that person can use that information, or you can when you go to refi because you've had a steady short term rental. Yeah.
Great. Is there anything else that we should know as far as loan programs out there that might be useful information now?
Yeah. So there is a DSR loan. I don't know how much you've heard about those, but those are basically based on the investors, um, the property that you're buying. It's less about the borrower and more about the property. So if a client finds a property that's really amazing and has so much potential, right? But it needs a lot of work, but they're a contractor or they're an investor, they can get that based on just the house and its projected um, value and what it will be and what it can be, or the income that it can bring. So that's a different type of loan, based on the property and less on the borrower. And I have a lot of investors that have used that in the past too. So that's one way to look at it from an investor standpoint. Um, or doing a short-term loan to get it fixed up and then refinancing it into a permanent loan, you know. So sometimes you have to, if you're trying to flip properties or be an investor, sometimes you have to take the shorter term loan, get it
Mm.
where it needs to be, and then get it into that like permanent loan, which is something we do a lot too.
What about, I know, well, you heard of people wanting to build a second home or um, in-law quarters on their property, like,
Yeah, like an ADU. I was just gonna say that. Funny. We were like on the same wavelength. I was just gonna say there's also ADU. So ADU stands for accessory dwelling unit, and a lot of people are going that way, right? Just because housing is more expensive. And I'm seeing that a lot more. How can I get my mom to move in here? How can my young son and his wife move in for a few years and save up? Like, can I get a rental property on my property to help me with my income? I mean, with my rent, my mortgage. And we do. So there are loans right now that allow you to add an ADU to your property. So you can either do that through a couple ways, a refinance with the money allotted for the ADU. You can do a second loan for the ADU. Or if you find a property that already has an ADU, then we can take that too, of course, and then project out what it would make as a rental income and count that. So I just had one where he was a traveling nurse and he was going to live in the main house, but there was a second little house in the back. But nobody had been renting it out, but he wanted to start renting it out because it was just a mother and a daughter before. So they weren't keeping track of that, but he wanted to do that, and he didn't qualify unless we got the rental income from the ADU. So when we ordered the appraisal, we got the rental income, what it would be, what the appraiser said that could rent for was like $1,100, and we gave him credit for that at 75%, and then that helped him qualify because that was his plan. So now he got a property with an ADU attached in
Perfect.
a converted garage. Yeah. So, I mean, there's a lot of creative ways to do that. But if you're thinking of adding one to your property, we do have construction loans for that. Sometimes the second loan actually makes more sense than for the ADU than doing a construction loan, but you can do any of those depending on the equity in your property. Mhm.
So as far as the rates between taking a second loan and just refinancing, what, which one do you think might be better?
Um, it honestly depends on where their first is, right? If their first is at 5 or 5.5, then I'm going to say let's take the second loan for the ADU. you
Right.
know, because we don't want to touch that first loan because it's such a great rate. Um, but if they were one of the people that bought in the 7.125 or 7.25, then let's touch that loan and wrap it into one. So kind of, we want to make sure we look at all the angles.
And a
Really.
lot of times we are going to be talking to people who have a 3% interest rate.
Yeah,
And
and
so,
and most of the time those are the people wanting to add the ADU, right? Or 4%. And I'm like, let's do the second. Let's do the second for the ADU. Um, because it's called a HE loan. So it's not a HELOC, it's a HE loan. So it is amortized over 30 years. The payments are lower, so you're not under that gun. It's like pay interest only for 10 years and get it paid off. You could, if you wanted, you could pay it off early and make extra principal payments, but it does give you that lower payment, which a lot of people need for that ADU to get it up and running.
yeah.
So the HE loan's a really good option for that. And I probably use that the most
Mm.
doing the ADUs. There are some rules on ADUs, and we have to make sure your county allows it. We have to make sure your lot's big enough, and then the type of ADU you're going to allow.
Okay.
So, um, there are some requirements there because sometimes people say, I took this money out, now I can't get my ADU.
Mm.
Maybe they did it with someone else, or they went to their credit union and didn't talk through the whole process. And now they're like, okay, I got to give that money back. I got to go over here and get the construction loan. So you
Oh,
want to make sure you're talking to someone who's done the ADUs before and you're not just thinking you can do it because there are some requirements to it and the county is strict on those. You can't just move any unit onto your property.
right.
But um, well, you can, but they might ask you to move it later.
Exactly.
So
You can do whatever you want
so
until you
let's
can't.
do it right the first time and then you don't have problems down the road. But yeah.
Okay. All right, Jody. Well, thank you so much for your time. Definitely, I'll put your link on the description here for
Yeah.
everyone to see. And if there is nothing else that you want to talk about with regards to loan and rates, I will have you next time. We'll have to plan for an update because I'm sure
Yeah.
we are, going to see more changes here pretty soon with all these.
Yeah, we are, and I'm happy to help anyone. Like I said, I know a lot of it's buyer specific, but there are a lot of options and ways to navigate this market.
Mhm.
I think a lot of us, you, me included, we're still investing in real estate. We still know there's opportunities out there, so we want to help everybody find those where we can.
Absolutely. Thank you so much, Jody. I'll see you
Okay.
next time. Thank you, everyone.
Okay.